Good evening, everyone, and welcome to the 2025 Pi Funds Investor Series. It's fantastic to see a full audience here tonight. We've reached over 1,000 of our valued investors over 5 different cities around NZ and 6 different events. So for me, that's a pretty good sign that it's not just markets that are having strong growth this year. For those of you who don't know me, my name is Mike Taylor. I am the founder and Chief Investment Officer at Pi Funds, and I will be the MC for the event tonight. You will also have the privilege of hearing from me as well, talking about markets in a short moment once I've done my introduction. So it really is great to see you all here tonight, and thank you so much for coming out to see us. Before we dive into the fun stuff, just a quick bit of housekeeping. Now, as you all know, that past performance is not a guide to future returns. It's really unfortunate, I know, but it is what it is. Information contained in tonight's presentation has, we believe, to be gathered to be accurate at the time that we made this. Now, in the unlikely event of an emergency, escape path lighting will guide you to the exit. I will now point out your nearest exit. Count the rows to your nearest exit and be aware they may be behind you. Life jackets are located under the seat, and I will force you to use them if you ask me a question about crypto tonight. Bathrooms are located down in the foyer, and please make sure that your phones are on silent. So now 2025 has been a good year for us. Although I did need to leave the seatbelt sign on for the first 4 months while we navigated the tariff turbulence. Positively, as you have seen, we hit quite a few good milestones throughout the year. You may have seen just in the pre-roll that was up there. We've had 2 funds actually this year that have achieved a 10 times return. I don't actually know of any other funds in New Zealand that have done that. Come find me afterwards if you can. But it's quite a big milestone for us, something we're really proud of, those 2 Australasian funds. You would have, if you've been with us for a few years, you would know that I stood up here in 2021 and said that I wanted to make $1 billion for our clients. Well, it took a little bit longer than I would have liked, but I can say quite proudly that we have made over $1 billion for our clients now in 2025. So we're really pleased about that. Thank you. So it's great to see the funds moving in the right direction. We've kept our focus on disciplined investing, long-term performance, and staying true to our philosophy. So tonight really is about saying thank you for your trust, your patience, and your continued partnership. You know, we couldn't do what we do, I guess, without you, our clients. So before I introduce the speakers, I'd like a show of hands on a question that I will come back to at the close of the event. So how many, I'll have to probably get out of the lights, how many people added to their investment portfolio, it doesn't have to be with Pi, could be anywhere in the market, just put money into the market in April this year? That's quite good. We've got some good astute investors out there. It's good to see. Now, how many of you, though, think that you'll probably add to your investment at some time, in the next 10, 20, 30 years, basically the rest of your lifetime? Hopefully that should be everyone. Great. Now, I will come back right at the very end to talk about that and what that means and how it's really important. So as I said, we've got a great lineup of speakers coming tonight. At the front of the aircraft, looking after you is me, and I will start with a quick roundup of markets, where we've been, what's changed, and what's next. Then we'll hear from our guest speaker, Dr. Oliver Hartwich, who will share his thoughts on the New Zealand economy and what lies ahead. In our premium cabins, we've got a great team looking after you. We've got Kent Williams to discuss global markets, helping make sense of the chaos and the calm. And then we've got Toby Woods taking sort of Peter Pan type flight or tour of the UK and European markets, which thankfully have been slightly less dramatic than the politics of late. Finally, running our first-class cabin today, we have Michelle Lopez, who will bring us home with insights into the Australasian markets and maybe even a few good stock stories. So it is shaping up to be an insightful evening with plenty of opportunities for good conversation, smart questions, and maybe even a few laughs along the way. The Friendly Pi Funds crew are here to look after you, so sit back, relax, and enjoy the flight. Now, let's get started. It's all right, I'm just going to switch notes so I can wander around while I talk to you. AI, is it in a bubble? I'm sure that every person in the room has probably got an opinion about this, and if you're not hearing about it from us, you're seeing it in the news media, you're hearing it on the radio, you're talking about it with your friends. It's basically all we seem to hear about, and quite a lot of the narrative around it is quite panic-stricken and very alarmist. Sky's falling, bubble's going to burst, that type of thing. But here's the thing about bubbles. Even if it is a bubble, what does it actually matter for you as an investor? Because not all bubbles are bad news. In fact, you can make a lot of money during bubbles. They also drive innovation, they can create enormous value, and as history shows, they tend to go on a little bit longer than people think. And last time I checked, we've only been hearing about bubbles for a couple of months. So what we have here is a recent bubble to talk about. This is the dot-com bubble. It's the most comparable one that we can look at. And the dot-com bubble has a lot of data on it because, of course, we had the internet at that stage, so those things got recorded. What we have here is the number of times that the media mentioned bubble from the early 90s. And what's really interesting about this, as you'll notice, is that people keep talking about the bubble, or the peak of bubble discussion actually comes after the market's peak in 2000. And it is quite clear that people were talking about bubbles years before the 2000 peak. So the next time you hear about AI being in a bubble, just think about who's saying that and what is their source, what is their reason for it. And if it's coming from the media, you should usually think, we'll take everything with a pinch of salt, because often the media actually arrives to the party late. The last point I would say on that is usually the noise gets loudest right at the end. So let's put it all in perspective. Let's compare 1990s bubble with today. You'll see the 1990s move in green, and we'll compare that to the current move in white. I've chosen these periods because in 1995, it's roughly the time that Amazon launched, and also when people considered the start of the internet, and the 5-year run to the peak in 2000. The comparison is from the launch of ChatGPT, roughly also the bottom of the market, November 22, to today. So you can see that two comparisons are quite stark. You've got one that lasts about 5 years, another one has only been running for a couple of years, and also a 1,000% gain versus a 200% gain. Did you also know that during the period from 1995 until 2000 peak, the NASDAQ actually had a number of 10% corrections? In fact, it had 12 10% corrections over that 5-year period when investors were worried about bubbles and getting shaken out. But in fact, the market continued to climb. So I think what it's illustrating for us here is that, yes, we think markets have gone up, that's quite obvious, but we're nowhere near the kind of mania that was around for investing in the late 1990s. But why is all this sort of mania here? So, I've seen AI valued at $1.46 quadrillion. So that would be the company or the country to first come up with AGI, being $1.46 quadrillion. So there's a bit of a race going on out there. And it's not just Google and Facebook. It's actually countries that are trying to win this race. Hot off the press today, I read that Trump has just signed the Genesis mission. What is that? It's to accelerate AI for scientific discovery. And in my kind of meaning, that means it's all on, folks. There's a lot more money going to be spent. We are only getting started in this. So the good news, the music is still playing. There is no need to go out and panic sell your NVIDIA shares, even though they are off the high. Of course, look, this is a risk. Investing in any case, this is a risk. I may be completely wrong. But from what we're seeing is that you have no need to be too panicked from all the AI bubble talk. Coming in with another plane analogy. The US economy is running it hot at the moment and coming in hot. So the white line that we've got there demonstrates the US government budget deficit. The last time the US government was operating a budget surplus was during Clinton's time, so it's a very long time ago. And you can see what tends to happen with government spending is that during times of war or recession, they go into a budget deficit. A good economist in the front row can explain why that's a positive thing for economies. I'm not going to go into that. But usually after that period, you want to get your budget back to being balanced. Otherwise, you wind up in trouble. By trouble, I mean this line. This is the US government debt, and we can see here that it continues to decline. The only time it goes sideways is when they have a debt ceiling and they argue for 40 days about what to do, and they shut down the government. Every time it reopens, it goes back up again. So this is a problem. The US economy is really spending a bit like the Greek economy in the early 2000s. They're trying to get admitted to the Eurozone, and they were lying on things. So the US is just spending like Greeks drunk on ouzo. They shouldn't really be running a deficit of 6.5% at the current point in time when the economy is still doing pretty strong. It is quite remarkable really how the US economy just continues to chug along. There's absolutely no way that New Zealand would be able to borrow money from anyone if we had a debt situation that looked like this. And yet they remain the largest empire. But it's not just the US, it's all the countries, all the developed countries around the world have got too much debt, essentially. And, the average level of debt now is at levels not seen since the Napoleonic Wars. That's sort of over 200 years ago. The last time there was a big surge in government debt was after the Second World War. But the difference between then and now is that governments are a bit like insurance companies. They're expected to provide a significant number of benefits to all their members. And at some point, I guess, there will come a day of reckoning when countries can no longer borrow. It doesn't seem like we've reached that point yet, although there are a number of countries that have come quite close. The UK probably is a good example of that. But for now, AI and deficit spending is the measure du jour, and it's kind of powering the US and global economies along. However, if we all keep spending like this, gold might soon need to become the reserve currency. So speaking of something shiny, let's have a bit of a chat about gold. This year, gold has lived up to its name of being a very precious metal, and central banks have started buying in record amounts. Prior to the GFC, central banks were actually getting rid of their gold deposits in favour of owning US treasuries. Now, with the current geopolitical situation that we have, a lot of countries, namely say Russia or China, don't really want to have all their reserves in US treasuries, so instead they've started buying gold. So you can see the net buying from central banks started taking place from about 2009 onwards. But it's not just central banks that are driving up the price of gold. It's fund managers and speculators as well. But how much has gold really gone up? If we compare it to the last big gold boom in the 1970s, when there was inflation, oil shocks, lots of geopolitical risks around, gold went up almost 2,000% over that time period, before a sort of a steady decline almost until 2000. So today's boom in gold, yes, gold is trading at $4,100-ish an ounce, US dollars that is, not New Zealand dollars. And the theme of today, I suppose, is that people are looking for an alternative other than the US dollar, something where that's a store of value, and I guess that's what gold has done, and it's proving to be popular. I guess after all, there's no quarterly earnings call for gold in uncertain times. So let's zoom out. What's the summary for today? What's the takeaway for today? I've got the positive points put up there with ticks, and the negative ones, or potential negatives with a cross. We are in a bull market. In a bull market, prices generally go up. They also have corrections, like we've just had. They are normal. Prices do go down. But sometimes, even in small corrections, people can get quite panicked. The market's actually not up that much. The NZX is flat for the year. Be lucky if it's up 1%. The ASX is up about 5%. And yet, even the tech-heavy NASDAQ year-to-date is only up about 15 or 16%. This is not what you would expect at the top of a raging bull market with a bubble. You would expect a year where the market's up 50%, similar to what happened in the late 1990s. We've got some strong fiscal spending. I've talked about the US. There's a lot of big fiscal thrust coming from them early next year. Toby will talk about fiscal spending coming from Germany. I've just been mentioning the movement in gold, which has probably got some time to run. AI productivity, we don't even talk about that. We're just talking about the bubble. There's so much productivity that's still to come from AI, and a lot of money is being poured into that to ensure that we all become more productive workers. So if history is a guide, the best is yet to come for investors. If you believe that this will blow into a big gigantic bubble, then surely the best is yet to come. Of course, we still have the three strong men in the room. That is Trump, Xi, and Putin. And who knows what could happen there. I've been mentioning that a possibility could be that they get together in a room and they sit down and say, right, well, I'll have Taiwan, you can have Greenland and Venezuela, I'll take the rest of Ukraine and the Baltic states. People laugh, but, all things are possible. Of course, at some point, if tech stocks continue to get bid up higher, the bubble will always burst at some point. I put in there high valuations, but that's only really for certain sectors of the market. I don't think that we can universally say that stocks overall are expensive. There's definitely parts of the market that might be, but also lots that we look at that are not expensive at all. I am very conscious that we have gone over time, and I don't want to keep you here too much longer. I would love to do Q&A from the floor, but unfortunately that would probably drag us another 10 or 15 minutes. So we will all be around outside afterwards to answer your pertinent questions. But before you go, I'm going to come back to that story that I mentioned right at the start about investing in April versus over your lifetime. And the reason I want to draw that to your attention is because last month I was traveling around and I came across a client. And we went over and said hello to him, and he wasn't that friendly. And I thought, why was he not that friendly? I didn't obviously ask him, but got back to the office and had a look at the account to see how long he'd been a client and what his return had been. And he'd been with Pi for 6-7 years. No, there we go. Got one. Thank you. That is a meme. If you don't know what it is, 6-7, you can find a young person in the audience or at home, and they will tell you all about it. Anyway, so he'd been a client since 2018, looked at his returns, and he had a return of 4.4%. I thought, well, how is that even possible? So it turns out the fund that he'd been in, which is the chairman's fund, over that time period had delivered 11% compounding. So what went wrong? Okay, so I looked back at his transaction history, and I could see that he'd made 3 withdrawals. The first withdrawal he made was in March 2020, during the COVID sell-off, when the market had fallen about 35%. The second withdrawal he made was in early 2022, when the market was selling off, start of the Ukraine war, and inflation going up to 10-11%. And then the final withdrawal he made, the nail in the coffin, was in the tariff sell-off in April 25 this year. So those 3 withdrawals destroyed his opportunities of a good return as a client, and as a consequence, he wasn't really happy when I went over to his table at breakfast to say hello. So what can you do differently so you don't leave this room unhappy about Pi? So the thing to do is, when you make an investment, say I'm making this for 5 years, or I'm making it for 10 years, or whatever your time frame is, and then don't do anything. Just leave it there. Let it do what it needs to do. If you don't like us for some other reason, okay, you can go. But if you are happy with Pi and you're happy with the performance, let the team do what it does best, and let your money do what it needs to do, which is compound over a period of time. The other thing, of course, is that if you can add to your investment, then that will give you the opportunity to actually beat us. So if, when markets do go down, you add to your investment, you don't take it out, then you will end up with a better return than what we publish. So if there's only one lesson you go away with today, is that when we go through the next inevitable panic in market, don't use it as an opportunity to yank money out and lower your long-term performance. So I hope you've enjoyed this evening tonight. Sorry, apologies, we have gone a bit over, but thank you very much for coming along.